Right now, as you're watching this, the United States government is adding 68,902 to the national debt. Every single second. That's not a projection. That's happening right now. In the time it takes you to watch this video, 20 minutes, America will add another 82.7 million to a debt pile that already stands at $38 trillion. Wall Street isn't pricing this in. The talking heads on financial TV aren't discussing it. Your financial advisor probably hasn't mentioned it, because it's happening slowly, gradually, 1 second at a time. 68,902, 68,902, 68,902. But here's what nobody's telling you. We've crossed the point of no return. This isn't a budget problem we can fix with spending cuts or tax increases. This is a structural debt cycle collapse. And the math, the pure, undeniable mathematics, guarantees it ends in one of three ways: default, hyperinflation, or austerity so severe it destroys the economy anyway. This isn't 2008. In 2008, we could add $10 trillion in debt to save the system. This time, we're already at 123% debt to GDP. There's no ammunition left. When this breaks, there's no one to bail out the government. And it's going to break. The numbers are staggering. $38 trillion in total debt. Our entire economy produces about $31 trillion per year. We owe more than our entire economy can produce, and we're not slowing down. Fiscal year 2025, we added $217 trillion. That's $595 billion per day, every day. Weekends included, holidays included, while you sleep, while you work, while you watch this video, 68,902 per second. And here's what makes this different from every other debt crisis in history. We're the reserve currency. The US dollar is the foundation of global finance. When we collapse, not if, when, it takes the entire system down with it. But you wouldn't know any of this from the stock market. S&P 500 near all-time highs. Bond markets calm. VIX near historic lows. Why? Because JP Morgan's chief strategist said it perfectly. America is going broke slowly. Slowly. That's the word that kills you. Because slow-motion catastrophes don't trigger fear until it's too late. And by then you can't get out. Let me show you why this is inevitable. Why the math guarantees collapse. And more importantly, how to position yourself before it's too late. The three debt bombs. There are three debt bombs ticking simultaneously. Government debt, corporate debt, household debt. And they're wired together. When one explodes, it triggers the others. That's what makes this systemic. Let me show you each one. Bomb number one, sovereign debt. The $38 trillion government debt. But here's what most people miss. There are actually two numbers, and both are catastrophic. Total debt is $38 trillion, which is 123% of GDP. But economists focus on public debt, the amount owed to actual investors, not government trust funds. That's $30.3 trillion, or 99.9% of GDP. Why does this matter? Because we've already exceeded the World War II peak. In 1946, after borrowing massively to win the war, total debt hit 106% of GDP. We're at 123%. We're higher than the worst crisis in American history. And unlike 1946, we're not done fighting a war we can stop borrowing for. This is permanent, structural, and it's accelerating. Right now, we pay $880 billion per year in interest, net interest. That's already the third largest item in the federal budget, behind only Social Security and healthcare. But here's the killer. Interest costs have grown 2.5 times in just 3 years, from $352 billion in 2021 to $880 billion in 2024. And the Congressional Budget Office projects $1.8 trillion in annual interest payments by 2035. Let that sink in. $1.8 trillion per year, just to service the debt, not to pay it down, just to pay the interest. That's more than we currently spend on defense, Medicare, or anything else except Social Security. And every dollar spent on interest is a dollar that can't go to infrastructure, education, defense, or anything productive. This creates a death spiral. Higher debt means higher interest payments. Higher interest payments mean bigger deficits. Bigger deficits mean more borrowing. More borrowing means even higher interest payments. It compounds. And once you're in the spiral, the math takes over. There's no policy that fixes it. The Congressional Budget Office, not some doom and gloom blogger, the official government forecasters, project that without changes, debt hits 118.5% of GDP by 2035 and 172% by 2054. But here's the thing, those projections assume no recessions, no wars, no crises, no unexpected spending. In other words, they assume a fantasy. Bomb number two, corporate debt. American corporations are sitting on record debt levels, and much of it was issued when interest rates were near zero. Now rates are at 4% to 5%, and all that debt needs to be refinanced. Companies that were paying 2% on their debt now have to refinance at 5%. That's 150% higher interest costs. Profit margins get crushed, stock buybacks stop, dividends get cut, and when earnings disappoint, the market reprices everything. But it gets worse. A huge wall of corporate debt matures between 2025 and 2027, hundreds of billions in bonds coming due. And companies have two choices: refinance at much higher rates or default. The strong companies refinance and survive with lower profits. The weak companies default. And in a default wave, the strong companies suffer too because their customers go bankrupt. Bomb number 3, household debt. Credit card debt just hit all-time highs. Student loan debt sits above $1.7 trillion. Mortgage debt is at record levels. And many homeowners are locked into 3% mortgages but can't afford to move because new mortgages cost 7%. Auto loan delinquencies are rising. The average American is over-leveraged and one paycheck away from crisis. And here's how it all connects. When the government has to cut spending because interest costs are eating the budget, that means layoffs, both government workers and contractors. Those people stop spending. Businesses lose revenue. Corporate earnings fall. Companies lay off workers. More households can't pay their debts. Credit card defaults rise. Banks take losses. Banks tighten lending. Credit freezes. The economy contracts. Tax revenues collapse. The government deficit explodes and the cycle accelerates. 3 bombs, all connected, all ticking. And the timer is running out. Let me show you why this is mathematically inevitable, not probable, inevitable. Because once you understand the numbers, you'll see there's no way out. Start with the current situation. We have $38 trillion in debt. We're running deficits of about 6% to 7% of GDP every year. That's $2 trillion in new borrowing annually. And we're paying $880 billion per year in interest. Now here's the key question. What happens if interest rates stay where they are? Or God forbid, go higher? Let's do the math. If the average interest rate on our debt is 4%, and that's conservative, it's actually climbing toward that. We'll be paying $1.52 trillion per year in interest within a few years. Not in 2035, in the next 2 to 3 years. Add that to our $2 trillion in annual deficits, and we're borrowing $3.5 trillion per year just to stay afloat. That pushes total debt to $42 trillion, then $46 trillion, then $50 trillion, and every trillion we add increases the interest bill. $42 trillion at 4% is $1.68 trillion in interest. $46 trillion is $184 trillion. $50 trillion is $2 trillion. You see the spiral? The debt grows, the interest grows faster, the deficit explodes, we borrow more, the cycle compounds. This is what economists call a debt-death spiral. And there are only 3 ways out. Option 1, we grow our way out. We increase GDP fast enough that the debt-to-GDP ratio stabilizes or falls. Sounds reasonable, right? Except the Congressional Budget Office projects GDP growth of 1.8% per year. We'd need 6% annual growth just to stabilize the debt ratio at current deficit levels. 6%. When's the last time America sustained 6% annual growth? The 1960s. It's not happening. The demographics don't allow it. The productivity trends don't support it. The math doesn't work. Option 2, we cut spending. We run surpluses and pay down the debt. Except here's the problem. The 2 biggest spending categories are Social Security and Medicare. They're growing automatically because the population is aging. By 2035, Medicare goes from 3.2% of GDP to 4.0%. Social Security goes from 5.3% to 6.0%. That's not discretionary. You can't vote to stop people from getting older. And the 3rd biggest spending category, interest on the debt. Also not discretionary. You have to pay it or you default. So the 3 largest spending items, which together account for most of the budget, are all growing faster than the economy. You could cut defense spending to 0, eliminate every federal department, and you still couldn't balance the budget. The math doesn't work. Option 3, we raise taxes. Except we'd need to raise taxes by about 4% of GDP just to stabilize the debt ratio. That's roughly a 25% across-the-board tax increase on everyone. Income taxes up 25%, corporate taxes up 25%, payroll taxes up 25%. Is that politically possible? Have you seen Congress lately? They can't even agree on basic appropriations. A 25% tax increase would require a political consensus that hasn't existed in America for 40 years. So all 3 conventional solutions are impossible. Can't grow fast enough, can't cut spending enough, can't raise taxes enough, which means the math forces one of 3 unconventional outcomes. Outcome 1, default. Just stop paying. Never happened in US history. Would destroy the dollar's reserve status overnight. Global financial crisis makes 2008 look like a practice run. Outcome 2, austerity. Slash spending by 30% to 40% overnight. Social Security cuts, Medicare cuts, defense cuts, everything would trigger immediate recession, maybe depression. Tax revenues collapse, making the deficit worse. Politically impossible. Outcome 3. Inflate it away. Print money to pay the debt. Devalue the dollar. Your savings lose 40% to 50% of their purchasing power. Different kind of default, you get paid back in worthless currency. 3 outcomes, all of them catastrophic. And the math guarantees we get one of them. The only question is which one and when. So when does this happen? What's the trigger? Let me show you 5 events that could start the cascade. And understand this, we don't need all 5. We only need one. Trigger 1, an interest rate shock. Right now, the 10-year Treasury yields about 4%. The Congressional Budget Office assumes rates gradually decline to 3% over the next decade. But what if they're wrong? What if rates spike to 6% because investors demand higher returns for the risk? Our interest costs don't just increase, they explode. $80 billion becomes $1.5 trillion, then $2 trillion. The deficit doubles. Foreign buyers panic. Rates spike higher. The spiral starts. Trigger 2, a foreign buyer strike. Right now, foreign governments and investors hold $8.5 trillion of our debt. Japan holds $1.1 trillion. The UK holds $809 billion. China holds $756 billion. They keep buying because the dollar is the reserve currency and treasuries are safe. But what happens when they decide they're not safe anymore? When China or Japan or the Saudis say, we're not buying more, in fact, we're selling. Treasury auctions fail. The Fed has to print money to buy the bonds. Inflation spikes. The dollar craters. Game over. Trigger 3, a recession. All the current projections assume no recession, but recessions happen every 7 to 10 years on average. When recession hits, tax revenues collapse. Corporate profits fall, so corporate tax revenue falls. People lose jobs, so income tax revenue falls. But spending automatically increases. Unemployment benefits, food stamps, Medicaid. The deficit that's 6% of GDP in good times becomes 10% or 12% in recession. And if we're at 123% debt to GDP when recession starts, we hit 140% by the time it ends. That's Greek territory. That's when markets panic. Trigger 4, the tariff revenue collapse. The current budget assumes $4 trillion in tariff revenue over the next decade, but those tariffs are facing legal challenges. The Supreme Court could rule them unconstitutional. If that happens, the government has to refund billions already collected and loses trillions in projected revenue. The deficit explodes. Markets reprice the risk. Yields spike. Trigger 5, a debt ceiling crisis. This one's coming for sure. Congress has to raise the debt ceiling multiple times over the next few years. Each time is a political battle, and all it takes is one time where they don't raise it in time. One failed auction, 1 week where the government can't borrow. That's the match that lights the fuse. 5 triggers, we only need one. And the odds that we avoid all 5 for the next 5 years? Close to 0. So let me walk you through what happens. Month by month, phase by phase. This is the avalanche timeline. Phase 1, the slow crack. That's right now, 2025 into early 2026. Debt keeps growing at $2 trillion per year. Interest costs keep climbing. Foreign buyers slowly reduce their treasury purchases, not dramatically, just gradually. 1% here, 2% there. The market notices but doesn't panic. The 10-year yield drifts from 4% to 4.3%, then 4.5%. Uncomfortable but not catastrophic. This phase can last 12 to 18 months. It's the calm before the storm, and it's the last chance to position yourself. Phase 2, the market realizes. Late 2026 into 2027. Something happens. Maybe a recession starts. Maybe a foreign buyer announces they're reducing treasury holdings. Maybe a debt ceiling fight goes badly. Whatever it is, the market suddenly reprices U.S. sovereign risk. The 10-year yield jumps from 4.5% to 5.5% in a matter of weeks. Stock market falls 15% to 20% as investors flee to cash. But here's the key. It stabilizes. The Fed cuts rates. The government announces emergency measures. Everyone thinks the worst is over. It's not. This is the dead cat bounce. This is when the people who didn't position in Phase 1 panic and sell everything at exactly the wrong time. Phase 3, the cascade. 2027 into 2028. The higher interest rates from Phase 2 start hitting the real economy. Companies that need to refinance debt face rates 2% to 3% higher than they expected. Margins collapse. Layoffs begin. Unemployment rises from 4% to 5%, then 6%. Consumer spending falls. Retail sales disappoint. Corporate earnings miss. The stock market falls another 20% to 30% from the Phase 2 bounce. And now the government's fiscal situation deteriorates rapidly. Tax revenues are falling because of the recession, but spending is rising. Unemployment benefits, stimulus programs, automatic stabilizers. The deficit goes from $2 trillion to $3 trillion, maybe $3.5 trillion. And here's where it gets really bad. The government needs to borrow that $3.5 trillion, but foreign buyers are pulling back. Domestic investors are scared. The only buyer left is the Federal Reserve. So the Fed starts buying treasuries directly. Lots of them. They're printing money to fund the government. And everyone knows what that means. Inflation. Phase 4. The sovereign debt crisis. 2028 to 2030. Inflation is rising. Not hyperinflation yet, but 5%, then 7%, then maybe 10%. The Fed is trapped. If they raise rates to fight inflation, the government's interest costs explode and the economy collapses. If they keep rates low and keep printing, inflation spirals. There's no good choice. Meanwhile, the dollar is weakening. Countries start signing trade deals in yuan or euros, bypassing the dollar. The reserve currency status, the exorbitant privilege that let us borrow cheaply for decades, is eroding. By this point, debt to GDP could be approaching 150% or higher. Interest costs might be $2.5 trillion per year, the single largest item in the federal budget, larger than Social Security, larger than Medicare. And the realization sets in. This is a sovereign debt crisis in America. The unthinkable is happening. That's the timeline. And we're in phase 1 right now. The question is, what do you do about it? Why it's worse than 1929 or 2008. In 1929, when the stock market crashed and the Great Depression began, U.S. debt to GDP was about 16%. 16%. We had massive fiscal capacity. The government could borrow to build the New Deal, fund Social Security, put people back to work. We had room to respond. In 2025, we're at 123% debt to GDP. There's no room. There's no fiscal ammunition. In 2008, when the financial system was collapsing, debt to GDP was 67%, still manageable. So we added $10 trillion in debt to bail out the banks, backstop the housing market, fund stimulus programs. It worked. The system survived. But we used up our capacity. We went from 67% to 100% debt to GDP. We can't add another $10 trillion now. We're already at 123%. If we tried to add $10 trillion, we'd be at 155% debt to GDP. That's when markets lose confidence completely. That's when you get a sovereign debt crisis. So this time, when the crisis hits, and it will hit, there's no bazooka, there's no TARP, there's no massive stimulus. The government is already maxed out, and that means the crisis has to run its course. Banks that fail, fail. Companies that can't refinance, go bankrupt. Unemployment that spikes stays high, because we have no capacity to intervene. But it gets worse. In 1929 and 2008, the dollar wasn't the issue. The dollar was strong. It was a safe haven. When everything else was falling apart, investors bought dollars and treasuries. That gave us breathing room. This time, the crisis is the dollar. The crisis is treasuries. When investors lose confidence in U.S. sovereign debt, there's nowhere to hide. You can't flee to dollars when the problem is dollar-denominated debt. And here's the part nobody's talking about: the global implications. In 1929, the U.S. wasn't the reserve currency yet. The British pound was. When we collapsed, it was bad, but it didn't take down the global monetary system. In 2008, the dollar was the reserve currency, but the crisis was in private debt, mortgages, and banks. The sovereign U.S. government stepped in and fixed it. This time, the crisis is in sovereign debt itself. The U.S. government is the problem, and when the government that backs the reserve currency is in crisis, the entire global financial system is at risk. Every central bank holds dollars. Every country prices oil in dollars. Every international transaction ultimately settles in dollars. If confidence in the dollar and U.S. treasuries collapses, there's no replacement ready. The euro isn't big enough. The yuan isn't trusted. Gold can't handle the transaction volume. We're talking about a collapse of the global monetary system as we know it. That's why this is worse than 1929 or 2008. Those were financial crises. This is a monetary crisis, and we have no fiscal room to stop it. So what do you do? How do you position for this? Let me be clear. You can't stop this. You can't vote it away. The math is the math, but you can position yourself on the right side of it. First, understand what you can't do. You can't stay 100% in dollar-denominated financial assets and expect to be fine. Long-term treasury bonds? Those are going to get destroyed when yields spike. A 30-year Treasury bond loses 40% of its value if yields go from 4% to 6%. Your safe bonds become your biggest loss. You also can't assume the stock market is safe because stocks always go up. In a sovereign debt crisis, stocks denominated in the failing currency lose value in real terms even if they go up in nominal terms. If the S&P goes up 20% but the dollar loses 40% of its purchasing power, you didn't make money, you lost 20% in real terms. So here's what you do. First, reduce your exposure to long-duration US dollar assets. If you're holding 30-year bonds, sell them. If you're 100% in a US stock index, diversify. You don't have to go to zero. The US economy isn't disappearing, but don't be 100% concentrated in the asset class that's most at risk. Second, own hard assets. Gold has been money for 5,000 years and will survive a dollar crisis. Real estate, if you can hold it without leverage, preserves purchasing power through inflation. Commodities. Energy, things that have intrinsic value regardless of what currency they're priced in. Third, diversify internationally. Not everything, but some. Swiss francs, Singapore dollars, currencies backed by countries with low debt to GDP ratios and strong fiscal positions. International stocks and companies that earn revenue globally, not just in dollars. Fourth, keep liquidity. Cash in short-term treasuries, 3 months or less. When the crisis hits, you want the ability to act. The people who bought stocks in March 2009 made fortunes, but only if they had cash available to deploy. Don't be 100% invested when the crisis strikes. Keep 20% to 30% in short-term liquid positions so you can buy assets when they're on sale. And fifth, understand the timeline. We're in phase 1 right now. You have 12 to 18 months, maybe 2 years, to position. This doesn't happen overnight, but it's coming. And when phase 3 starts, the cascade, it'll be too late to reposition. You'll be selling at the bottom like everyone else. The wealth transfer is coming. The only question is, which side will you be on? Let me bring this back to where we started. 68,900 tours per second. That's the rate at which US debt is growing right now. In the 20 minutes you've watched this video, we added $82.7 million. Tomorrow, we'll add another $595 billion. Next year, another $2 trillion. And the year after that, and the year after that. This isn't a prediction. This is math. The Congressional Budget Office projects 118.5% debt to GDP by 2035 and 172% by 2054. But those projections assume no recessions, no crises, no surprises. They assume a best-case scenario, and in finance, the best-case scenario never happens. The structural debt cycle is collapsing, not might collapse, is collapsing, right now. The only question is how fast. Slowly, like JP Morgan said, or suddenly, when one of the 5 triggers hits. Wall Street isn't pricing this in because they assume it won't matter in their investment timeframe. They're wrong. This matters, and it's coming faster than anyone expects. 3 outcomes: default, hyperinflation, austerity, all catastrophic, all mathematically inevitable. The only variable is which one and when. You can't stop it, but you can position for it. You have time, not much, but some. 12 months, maybe 18. Reduce dollar-denominated long-duration assets, own hard assets, diversify internationally, keep liquidity. Position now, before phase 2 starts and it's too late. The math doesn't care about hope. It doesn't care about politics. It doesn't care about what you want to be true. It just executes. $68,902 per second. The clock is ticking.